big kind of literature that had looked at this. So first, kind of this idea of the global financial cycle through financial institution, the famous dilemma instead of trilemma papers, and also what happened with dominant currency prices. So basically, that export and import that are priced in US dollars. So basically, what is the effect of in that case, monetary policy shocks in the US, for example, in outcomes in those economies. And of course, like basically, there had been a lot of papers. So Len Ray and co-authors, Giovanni had some paper here, like trying to look at basically the effect of those global shocks in the local economy. But there have not been a discussion on what we want to kind of like to, what we want to discuss in this paper is the role of expectations, how basically expectation of, in this case, going to be firms, interact with these shocks, and then basically if there are some type of bias there or like kind of departure from rational expectation, and how basically we can understand those biases and the effect that those biases can have in the economy. And this is important because there is a huge growing literature that is way more focused on kind of closed economy that look at basal expectations. So of course we know that expectation matters, that economic agents are forward-looking, and there are a bunch of papers that have looked at that basically there is empirical evidence on, and first to measure expectations, to understand how expectation forms, and different bias that people have with form expectations. So basically how experience matters for expectations, and stuff like that. But also like we have seen recently paper that focus on the consequences of changes in inflation expectations on actual output of firms and consumers. So of course, like when we look at at surveys of expectation for consumers and firms, we have a bunch of biases. So people tend to report like high number, bunch number. There is a lot of uncertainty. But there are this world like kind of like in very controlled environment that have shown that firms and consumers, when they're basically adjust their inflation expectations, they also like can adjust their economic decisions. So that's why basically there is an interest in understanding this, and basically what we're going to do in this paper is try to understand how expectations change, and also like to explore a little bit on the consequence of these changing expectations when firms, in this case, are facing like global shocks. So again, like and what we're going to do mainly in this paper is to study the effect of U.S. monetary policy in the rest of the world. We're going to use one particular case that is going to be the case of Uruguay. So again, recent work have explored this type of effect in output and other variables. So again, like Miranda Lupino and Ray and Giovanni have paper basically where they look at the effect of monetary policy shocks in other economies. Also, again, like there is the literature of the U.S. Dominant currency and the effect that basically when dominant currencies are affected. So sorry, when trading was $1, basically that effect that has in the economies, in the other economies. But of course, like these effects also like interact with bad policies. Local authorities can do like in terms of policy, and we have discussed about macroprudential policies, and more generally we have discussed about basically what is the role of a fixed exchange rate, flexible exchange rate, or other type of policy tool. But in particular, like local authorities can help to attenuate like this effect. And of course, like all the discussion that we have had here, okay, let's use this type of policy, this other type of policy. In this case, we can use this and that. Then the question is when firms, for example, are exposed to this type of shocks and they see like kind of a U.S. monetary policy in U.S. monetary policy, a monetary shocks in the U.S., or for example, they see the currency depreciate, then how they're going to internalize? What is going to be basically what they think that the economy is gonna well, in this case, the central bank is going to do, or how the economy is going to evolve in the future. And then, like, of course, like that's a very complicated decision framework. So basically, we're going to first evaluate again like the effect of expectations, and then basically understand how basically try to also discuss why we see the reaction that we're going to see. I'm going to show you later in the paper. So in that sense, basically, we want to incorporate like kind of another mechanism to the literature of the global financial cycle. That is the kind of the expectation channel. How basically changes in expectation might also like kind of affect well the outcome of these shocks, and also can kind of create some problems or some challenges for the local authorities to manage expectation in that sense. So basically, again, like in this paper, what we're going to do is that we're going to see the effect of international monetary policy shocks on domestic expectations. We're going to use the case of Uruguay because I'm going to show you in a second. But basically, for Uruguay, we have like a great panel of inflation expectations survey for firms that evaluate behave and has very good properties that are going to allow us to measure the effect of these shocks very well. So basically, we study the effect of U.S. monetary policy shock, and using this individual microdata, we find that the effect of firms' inflation expectation and on cost inflation expectation at 12-month and 24-month are affected by these shocks. We find that also like there is some heterogeneity in terms of the firm of how they are exposed to the dollar, and a little bit in line with Michael's work on basically how experience affect your decision. Though like this effect is not going to be as big as we think. Also basically at the same time, it's not here, but we're also going to see how these shocks affect the Uruguayan economy. And what we're going to find is that actually the firms don't like basically react in the same way that the economy reacts. So basically firms are going to think that after this type of shock, inflation is going to go down. We're going to see the economy is going to have something different. So then basically we're going to try to discuss a little bit why this is the case. And then like we're going to discuss, I don't think, I'm not going to present that much the model, but basically how we can understand a little bit this effect in the case of basically in the context that we are looking here. Just to give you like a little bit of a review, a little bit of context. Of course, Javier can maybe probably explain more better this than me. But just like to give you like a little bit on that I think is going to be important for the discussion later. What is the state of the economy? So of course, like in 2022, like basically Uruguay after the Argentina crisis had like basically experienced a very strong financial crisis, and then since then they have gradually moved to an inflation targeting regime. Actually, since 2014, that is basically the period of the sample that we're going to look like. Basically, the target was between 4% and 6%, and I think that they recently moved it to between 3% and 7%. Up to 2002, Uruguay had an explicit crawling peg, basically with a narrow window. Of course, like when they moved to inflation target, they abandoned explicitly like this exchange rate intervention. But for exchange rate and Rogoff, basically according to their measure, they think that actually Uruguay in practice have like some type of managing floating of the shock. So then like again, like the question is after the shock that affect this economy, that's going to affect this economy, how firms are going to understand the policy regime that Uruguay is on. Like it's going to be very important to understand the effect on their expectations. So let's move to the data that we're going to use. So again, like the first part is this very well done, like a survey of firms' inflation expectations. So in the case of Uruguay, they have like this panel structure. So this panel of firms that ask every month about their inflation expectation and their cost expectation at 12 and 12 months, and so for the next year and the next 2 years. They have our question, I think, also at the end of the year, but basically these are the main questions that we're gonna use. The advantage of this survey, so I don't think it is necessarily an advantage, but it's something that makes it like very easy to work with, is that it's a very well-behaved survey in a way. Firms are very well informed about expectations in Uruguay, so actually you don't see like very big outliers and stuff like that. I'm gonna show you in a second a picture of basically how actually the average inflation expectation and the actual inflation behave in the case of Uruguay. Again, it's a panel, so we can identify the firm, we can control by firm, fixed effect, stuff like that. We're also going to have data, and then we can merge this data on firm expectation with other kind of administrative data that we're going to use in this paper. So if we have the credit position of the firm, we have also custom data of import and export. So basically, we were trying to see like how the firms like basically interacted, basically how the reaction expectation interacted with this variable. We're not going to find that much of an action, but yes, we're going to show you a little bit how those basically more like economic decision interact with the shock that we're going to show as well. Then like the monetary policy shock that we're going to use in the US basically is this one for Wu and co-authors that basically had the advantage that take into consideration the zero lower bound period. So basically, as our sample is going to be between 2014 and 2020, basically we're going to still gonna be able to measure some action there, something that with, for example, the Romer shock would be harder. And then also we're going to have monthly data on CPI inflation, exchange rate, economic activity, and short-run rate, interest rates, because I'm going to try to show you a little bit how these variables are affected by the shock. Yes?
So just to understand where you're going, so the idea is to think about how the U.S. monetary policy shock affect the inflation expectations in Uruguay?
Yes.
But if maybe I see a monetary policy shock and I don't expect any changes in inflation because I know the central bank of Uruguay is going to respond to that.
Yeah.
So how much is
So
the effect of the direct effect?
So actually, that was a little bit kind of like the first idea of this. So basically, if you see a monetary policy shock in the US and you have like a perfect inflation targeting, like then like kind of firms in Uruguay would say, okay, like we have something coming from abroad, I don't care. The central bank is going to take care of this shock. Inflation is going to be stable over time. So then, like the first test in a wave, like basically, do we have a result that is different than zero or not? So actually, that was kind of the first motivation of this paper. Then the question is, okay, like if we see a result or not, after we see a result, then try to understand better why basically this is to understand a little bit the result that we find, and that's going to be the end of the paper. But you're exactly right. Now in this context of like let's say like of global financial cycle, of course we know that actually central banks have a hard time managing this shock. So actually we might expect that firms are gonna react after a global shock. But you are exactly right. So that let's say like kind of the first hypothesis is basically if the coefficient is zero or not, and that's kind of like it's going to be the first one. Yeah. But also like basically what Giovanni have found, for example, in this paper, is actually when there is a monetary policy shock in the US, inflation around the world like react, and it might be optimal. Yeah. So this is just to show you like the dark line is kind of the inflation expectation of firm, like the average, and this is kind of the actual inflation in Uruguay, and you can see it's a little bit higher than the target. And again, like it's very smooth and well behaved in the case of Uruguay. Yep.
I didn't hear or understand. What's in that figure?
Sorry, here, so on the dark line is the average of our, so we take the average of our survey of firms' inflation expectation.
The solid line.
The solid line, yes. Yes, and the dashed line is the actual inflation in Uruguay.
Well, the expectations are about inflation in the future.
Yes.
12 months later. And then is the 12 months later then synchronized with the actual inflation, or?
No, so you can see, for example, here they were expecting this number here, and inflation was actually here like 12 months later. So yes, so they are not able to predict inflation. So I guess like it's important. So at the end of time, we live a lot in the rational expectation world. So in the case of survey, it's not always necessarily about forecasting expectation.
Inflation, but inflation actually fell. That's
exactly, yes. Okay. Yeah. So yeah, they weren't able to forecast the actual inflation level. But I want to highlight here in here, like of course, like we have the thing that they react to actual inflation environments. But for example, here they didn't go as down as inflation went. Actually, they were still expecting like some relatively high inflation when inflation went down. But there is this correlation with current inflation that is also like common in many surveys, and even like in surveys of professional forecasters and stuff. Yeah. So the first thing that I'm going to show you is basically how this monetary policy shock affect the Uruguayan economy.
Inflation is sort of anchored in that thing. The inflation expectations are anchored at around 9%. When the thing goes down.
Yes. Yes. So it seems that on average, firms in Uruguay have, like their expectations are relatively tied to 9%. Yeah, but this is the average. Of course, there is heterogeneity around that number. Yeah. So then the first thing is to see basically how this monetary policy shock in the US affect the Uruguayan economy. And here again, like there are other works that have done this. We just want to use this as a benchmark to basically to analyze then the result that we're that we're gonna see later. So what we're gonna do here is a very simple, like you're the local projection, where we're gonna have this monetary policy shock. We're gonna control for, well, J lag is gonna be 12 in any case. Here, basically, we face this trade-off. We're gonna add as many lags as possible, but also like we're missing a lot of data. So we're gonna use 1 year of lags. We have here is gonna be the percentage change of each variable. And then we also control by J lags of that same variable as well. And again, this is going to be aggregate data so far, so this is just like the same thing. And how this works, basically, in case you're not familiar, we run this regression. The left-hand side, like it's kind of like the right-hand side is kind of fixed, and then we move this percentage over time. So this is between t and t plus 1, t plus 2, t plus 3, t plus 4. We collect this beta H0, and that's going to give us the impulse response after the shock. And this is the effect that what we find in here. So first, like what is after a monetary shock in the US, as expected, we see a depreciation of the Uruguayan peso. We see a declining of economic activity. We see some inflation. Let's say, like here, maybe it's a little significant, but actually like not significant effect in inflation. That's a little bit like in contrast with other work that look at other countries. Usually, like they find some inflationary pattern, and then an increase also in the interest rate in Uruguay. Yes.
What's the size of the shock?
So that's the thing. Like this shock, like so this is a 50%, but the shock, the one standard deviation of the shock is 3%. So you have to, I forgot to mention that. Yeah. So this shock here, like one standard deviation is 0.03. So yeah, like all the results are going to be like kind of like way bigger than actually like what is a.
3 percentage points. Is the shock.
Yes, that's it's a So but the unit is
Enormous, right?
yeah.
That's, well, I guess it's multiplied by 300 basis points. Sorry, I just want to make sure that's a big shock. Usually people talk about maybe 25 basis, or sometimes it's normalized at 100.
So I think that here is like like it's 3 basis point.
3, okay.
Yeah, that's the shock here. Yeah.
3 basis points annualized or?
Analyze, I think it is. Yeah. Let me. I should.
That's very small.
That's very small.
Yeah, it has, yeah. Well, but we are between 2014 and 2015 and 2020. So yeah, like usually like the big monetary policy shock that we know is the one of the 80s, that the Romer shock. Here we're in a world with very small shocks. Yeah.
But that's because but that explains why in practice you get enormous shocks when you do these kinds of regressions, like
Yes, of course, yes.
60 basis points or something like that. But then the 3 basis points.
Yeah, this is a period of small monetary policy action in a way. That's one of the caveats of this of analyzing.
What's the period?
Between 2014 and 2020.
Yeah.
Yeah. Unfortunately, we don't have this data for.
Interest rate 0 all the time.
Yeah. Well, it's the period of the policy normalization.
At
Yes.
the very end, it comes up with.
Yeah. Sorry. Yes.
Could you just clarify how the shock? So is this like a typical Karate announcement?
So this is. This is the Burrell shock. So they do like kind of a 2-step exercise. So first, if I remember correctly, they kind of like regress like different like the different term structure of the of the interest fed on like kind of on a time series shock, and then they use that. Yeah, so we explained in the paper. I don't remember exactly how is the shock.
That makes a huge difference. The different measures of the shock. I mean, I guess the high frequencies now, the industry standard. Because even if the Fed hikes 75, the shock can sometimes only be 10 because 65 are priced in. So if you have something like that, 3 basis points might actually not be that small because the rest was priced in, but it depends on how your shock is defined, right? If this was a Taylor rule residual, then I think 3 basis points is really small. If it's a high frequency identification, I think 3 basis points might actually just be.
Is that because a lot of them in the high frequency might subtract out much because it's in use?
Exactly. So the industry standard is
More
to.
recent Swanson argues there are no news in there at all.
Yeah.
So this is high frequency.
Yeah, this is high frequency. Yes.
Okay, yeah, that was my question.
Yeah.
In the high frequency story about, there's a big, initially there was an idea that there's a big news component. And Swanson is really.
So there are two kinds of possible.
Oh, sorry.
Just make it sorry. I think the speaker needs to take control because otherwise we're gonna.
Yeah. Oh, yeah. So sorry. Yeah, but let me move quickly, actually. But yes. So yeah, there's this whole debate about the monetary shock. I should have like a quicker answer to this. I'm sorry.
It's really important because when you look at the bottom right, you want to know what you want to know, is that like 10 times bigger than the U.S.? Probably is.
10 times bigger than the U.S.
Well, I mean, if it's a 3 basis point, 60 basis point shocks, I think, produce like 0.5% of the move in GDP. I don't know what the move in GDP here, but
Yes. So well.
that's a kind of an important check on it.
Yeah, let me. I can share like more in line with what happened in the U.S. actually. Like I did at some point, but yeah, let me. Yeah. So.
This is a reduction in the interest rate or an
No, this is an increase in interest rate.
increase in interest
Yeah.
rate. Can you go back? So then inflation is the other.
So basically, this is depreciation. There is not that much pass through. Yeah.
So which maturity is increasing? Is this a conventional or is there a more short and medium maturities?
The shock.
Is that kind of conventional shocks or all on the short maturities? Or it's a
I think consider so what they do. What they say about this is that they merge both basically because they run this regression at the beginning in all the maturities. So they kind of like that's why basically like again like we focus more on the period of the policy normalization, but actually there are shocks for the period of the zero lower bound because of that. So yeah. So it had
more power.
yeah. So yes, and again, like this go a little bit like on the opposite line of, so in line with basically with what you found. For example, the only thing is that a little bit different is the inflation part. So then basically we move again like getting like that as a benchmark. Basically we move up basically running exactly the same regression, but for the case of the firm. So here we're going to extend the local projection, and what we do is that we take like the percentage change. This is going to be the percentage change of the inflation expectation of the firm. So just like, and we did in this way, it doesn't change it, we do just the change. But we did it this way basically to account for different, even if we have a firm fixed effect, that this is a relatively long time series, just like kind of like to escalate by the level of inflation expectation of the firm, but actually this work as well with different, if we just do like the one period change, again, we have the same controls, and the lags here standard cluster at the firm level, and again, like we use H and A equal to 2. So here what we find is after this monetary policy shock, we find a kind of a very like clear decline in inflation expectation of the firms. Again, like if you scale this by 3, actually, like this is basically a one standard deviation of this shock, basically decrease inflation expectation in 0.3%. So it was 10, like 0.7, for example. Sorry, if it was 10, it's 0.97, for example. Something that is interesting first is that the coefficient is different than 0, so basically firm react to this shock. Second, like this happened at 12 months and 24 months, so even like for medium run expectations, this have an effect. And also basically we have a milder effect, but also like an effect on the cost.
Divergence because inflation goes up, but then expected inflation.
Exactly.
Right?
Yeah. So we have that diversion in the sense that inflation goes up with 0, a move, and then like, but it seems that firms like tend to think the opposite. Yeah. So I'm gonna discuss that. We're gonna discuss that in a bit, but yes. So basically that's kind of like an interesting result. Also, like, and again, this is fairly new. Well, okay, so just to debate, like, kind of like, so the effect of the monetary shock in the U.S., the effect of that monetary shock in the U.S. in the Uruguayan economy, also, like, in a way, it's going to depend on what is the policy reaction of the U.S. So, of course, like, kind of, Uruguay have in that period a flexible exchange rate. Basically, we have a depreciation, and then inflation, like, tends to go up with that shock. But imagine, like, if, for example, the central bank would defend the exchange rate and react, like, mimicking the policy reaction of the central of the U.S., then what you will find actually is like there with no depreciation, actually a recession in Uruguay and prices would go down, for example.
Can you go back to that slide when
That's exactly basically where
Inflation goes down, costs go down. I assume output, that's why I asked you, you don't have an output forecast of output.
we don't have a forecast of output, no.
But costs going down suggests they're thinking that output's going to go down. It's beautiful.
No,
But the opposite actually happens.
Yes, I know. That's what I was saying. That was a divergence.
exactly. And that's exactly what we're going to discuss later. So it seemed that basically the firms of Uruguay, what's happening when there is this shock, is that they affect a harder recession than the one that actually the economy perceived. Yep.
You don't control what they expect what domestic monetary policy is.
No, we don't have expectation about domestic monetary policy.
And you don't control for what they're actually doing in
In Uruguay,
No, that's embedded in.
well, but that. So I think here, like, well, it's like as you say, like basically this effect considers whatever they think that the Uruguayan monetary policy is going to do. The thing is that we know for sure is that this shock is exogenous to the Uruguayan economy. So the U.S. monetary policy shock is not happening because something happened in Uruguay. So it's exogenous for the Uruguayan economy. The central bank probably react to that. We don't know. Officially, they might not, like, but that's something that we could ask them. But the thing is that firms in Uruguay, after this monetary shock, react, and they react like in the opposite direction of what happened. The thing that we did in the next slide, just to show you, like, is we found basically we got like a monetary policy shock for Uruguay, and then in that case, when we look at the data, we see a decrease in inflation, and also we see the same decrease in inflation expectation. So actually, Uruguayan firms' inflation expectation react in line with the data when there is a local monetary policy shock. They don't react with the data when there is a foreign monetary policy shock. Exactly. So yeah. So actually, that I'm gonna go to the discussion later, but yeah, that's exactly what we think. So as I explained at the beginning, Uruguay has a history of intervening the exchange rate. So then, like even if the central bank kind of say that no, we're not gonna do it anymore, the firms are still believing when they see a depreciation, they say, like the central bank probably is gonna intervene. A crisis is gonna become, and that's what what basically we claim. There is another challenge basically for the global financial cycle that actually, like, you might have like a policy recipe, but firms or expectation of economic agents have to be aligned with that policy, and that sometimes is hard to convince when you have a history of a certain policy in the past. So that's actually like we were going with this. So I have 5 more minutes, so I'm gonna move very quickly to some more stuff. So again, like maybe I can move quicker to the discussion. So we also like try to see like some heterogeneous effects. So in particular, if firms exposed to dollar through basically having debt in US dollar react differently to the US monetary policy shock. We find some effect of that, very small. We're expecting to have something bigger than that, but actually, yeah, like so basically their reaction in terms of inflation is milder if they are more exposed to US dollar. The same in terms of cost. Then something that's important, we see if this monetary policy shock changed the firm's decision. And what we find is actually like in line with the depreciation, they reduce the share of long and medium-term debt in US dollar. So that's the result that we find. We find here we don't have any effect on changing total debt or basically in short-term debt. We find some effect on imports for the most exposed firm. Again, like this is very small and not very big, but that's something that we find. And then, yeah, again, like the discussion at the end, I think I have one more minute to discuss it very quickly. Like, again, like
Explain that. I mean, always the reaction of prices are going to depend on the policy regime. What you mean is, why only a dominant currency environment prices depend on the policy regime? They always depend on the policy regime.
No, they always depend on the policy regime, but basically we're gonna discuss this in line with the. So basically, we're gonna use a model. Basically, we're gonna use this model out of the shelf and basically calibrate a DSG model like for the case of Uruguay. And what we're gonna.
Yeah, I don't understand the statement.
Okay. Yeah, so you're right. It's independent on the regime. Yes, so but basically we just wanted to set in that environment. And again, like basically what I want to explain, like basically we find that well, if we take, for example, out of the shell like this model of Flaganora and Spilandi, what happened is that the effect of the U.S. monetary policy shock is going to be positive in terms of inflation if there is a floating regime, or negative if there is a currency peg. So what we do is that basically we're going to take this model and we're going to basically have a small kind of like departure from FIRE, that basically we're going to have this version of the model where basically the economy is floating, but the firm's foreign expectation as the economy was paying. And basically what we find in that case, and this, you cannot see that, of course, like basically the effect of inflation, basically this is the line where the firm have this kind of buy expectation. It's kind of like a small in terms of inflation. And why this happened? Because firms expect that their prices, basically their costs, that actual inflation is gonna react downward after the shock. Why that happened is exactly because I was explaining before. Basically, they are in the economy. They see basically this depreciation. They expect that the economy is gonna contract, and then basically they revise price downward. Actually, this effect is kind of relatively persistent in terms of prices, and that's actually what we find in the data. So again, this could be one explanation of why firms react in this way, and this is the one that we just discussed 2 minutes ago. And again, like this kind of face a new challenge when we are talking about this kind of different type of policies in this context. That is basically how firm adjust expectation in this environment. So I think I'm out of time. Sorry about that. But just to conclude, again, using microdata, we basically see how expectation of firms react to monetary policy shock. We have evidence that they reverse downward their expectations, and that doesn't go in line with the effect of with what happened in the data. And then basically we try to discuss a little bit why this case and see. Well, thanks a lot for your.
Discussant, Tumisang Loate from the University of Pretoria.
Okay, well, thank you for the presentation. Yes. Okay, well, thank you for the presentation. I'm just going to skip to my questions because I think there's already been enough discussions. So the first question is based on one of your results where you look at the response of, the reaction for companies that rely on foreign currency debt, where you show that there's a difference between how the medium to the long-term foreign debt react as opposed to the short-term debt. So what I wanted to know from this is, is this just simply the firms reducing their exposure after the currency depreciation, or is there some substitution with local currency funding? Can you maybe expand more on this? And then also what I wanted to see or to check, it will be interesting to see if, firm characteristics do matter. And what I mean in this sense is, whether you have firms that are subsidiaries of companies that can borrow cheaper in US dollars in this case, and therefore get cheap funding. So are you able to then, within that heterogeneity of non-US funded and US funded, can you go even further to then see if whether those firm characteristics do matter? The second one is related to the short-term debt. I didn't really get the explanation of potential reasons why it's not really responding. And then the third one, it relates to the results where you find that there is some increase in in imports for those foreign currency funded companies. And what maybe I'm not understanding the results very well, but what I find it interesting is there's an expectation that your costs are going to increase, but then you then import more. How are those, isn't that going to increase your costs further? And then how are they funding those inputs, especially when you say that they reduce their foreign currency funding, unless maybe they also getting funding from somewhere else, substituting the funding. The fourth one relates to the, do we find evidence also in the data? Because, for example, in your presentation, you do show that, yes, firms do respond to, the expectations, right? But then is there also evidence in the actual data? Because, for example, you show that actual inflation doesn't actually respond to US monetary policy shock. And then the last one, it's just this question was motivated by a paper that I've read a while back by Ben Bernanke when he was, sort of defending this coining of, that the US enjoys this exorbitant privilege because of the US dollar. And what he was basically arguing is that, should we really blame the US for lack of monetary policy independence for emerging markets? So it's the same here. And for example, so when I looked at this graph where firms' inflation expectations are actually anchored at a much higher rate. They've never been within the band. And, for this, shouldn't we also look at more on the credibility of, the central banks or their lack of clarity on FX interventions or the exchange rate policy framework? Because like you're saying in your findings, is that, the firms seems to have a very distorted view of or their expectations. So you're saying that it looks like they think the central bank is following one exchange rate policy regime than the actual that the central bank is actually following. So for that, so it's can we really blame the U.S. Monetary policy central bank, or should we also not look at the credibility of the U.S. monetary policy? And I just added the graph just to compare, because I wanted to see how South Africa is also doing in terms of inflation expectations. Yeah. So those are my questions or discussions for the discussions.
Yes.
I actually want to follow up on your last point, because if what's going on is that the central bank is the local central bank is just reacting wrongly, and thus firms are changing their expectations because the local central bank doesn't do the right thing. The policy implication is a little bit different from the global financial cycle literature. The global financial cycle wants to blame the US, but here you're blaming the local central bank.
But so, I don't know if I'm blaming the local central bank.
But firms are reacting to a bad policy by the central bank.
Well,
Not
no.
necessarily to what the US is doing. They're creating an expectation of the US does this, and my central bank messes up and does this.
So I would
The
put
firms are just idiots here.
no.
Well, that's
I don't get it.
I don't know who's the main idiot, if it's the local central bank or the firms.
No, but I would phrase this like in a different way. So let's put it this way. We're using the shock in the US is a shock that happened to understand how firms in Uruguay understand the transmission of this shock, understand the policy of this shock. It might not be that kind of like that the Uruguayan central bank is doing the wrong thing. It might be that firms in Uruguay take a long time to actually get convinced about the policy framework, given the history of policy that they.
But one can think that the firms are stupid or wrong. I actually think that the firms, what happens is they're not facing a credible local central bank. Which in the past have reacted wrongly, and so it's not outrageous for them to think that the central bank is. I don't believe the central bank.
In that
So it does go back to what she said and Bernanke had said. Why are we blaming the U.S. for local central banks that are credible?
Giovanni,
Sorry.
Caterina, and Giovanni first, right? Yeah.
Another quick question on that. So the policy can be state contingent. It's countries when there are fairly large shocks, we try to avoid capital outflows, and perhaps in a regime in which shocks were very small, that was not happening. It was actually the optimum response from the central bank was not happening. That perhaps there was embedded expectation. That's a possible interpretation. I have a second interpretation about the instrument. I'm not completely convinced that this instrument is really capturing only monetary policy, because this is essentially obtained on the assumption of greater elasticity, and at the moment of the announcement, the dominant shock is monetary policy. But when you look at mid-maturities, it's hard to believe that it's really unconditional guidance rather than conditional guidance and information. So that shock can blend two things, and then you would have also the others, you know. But
Yeah.
Can I quickly?
But-
So there's work by Tim Kamen and other people recently in the JAE that says emerging market reactions to US monetary policy crucially depend on that combination of the various decomposition of the news there, right? And that's especially important for you because if you happen to be conditioning on the wrong kind of news, that in itself will be driving things around in unexpected ways, irrespective of how the central bank is reacting to that.
So this blue and orange shock, their one claim to popularity is that they clean the information. So in the local data, it will show that there is no information. So I don't know, internationally there is.
they show there's a good correlation with other shocks, but that's a claim discussed.
Caterina.
So I think it's a very cool paper, and there's so many things I would want to do with it, and I just want to give you some suggestions. First, I think just to avoid some of these comments, it would be super helpful to just plot how the central bank has reacted in the past, to see if it's rational, if firms are rational, assuming that the central bank is going, just to give us an idea. But I think what's even more important is this decomposition, and because especially for EMs, there's literature, I sent you the paper in the AEJ macro from 2020, that for EMs, there's two types of monetary policy shocks, right? And that's why I think the firms are not stupid. So
No, by the way, I do not think that.
No.
I think there's something wrong with the
no,
results.
exactly. I think there's noise.
It makes no sense to me.
But
that
let me try.
You could create the standard errors are way too tight. Each time there's a monetary shock, the firms think there's going to be a collapse in the economy. Each time it doesn't happen, I don't think they're that stupid, no.
But let me try maybe to, because you currently have one monetary policy shock that mixes two effects, right? You have a news effect of the monetary policy shock, which could be purely driven by the Fed thinking the US is actually going to do better than they thought, so we're tightening and inflation. That is an output shock, a positive news shock. And that generally for EMs is a good thing, because most EMs trade with the US or export to the US and so on. And then there is another pure monetary policy shock that actually just tightens and makes things worse in EMs because they face tighter financial conditions. So these two effects, actually the paper in the AEJ macro, and that's again Karadi decomposing the effects, right? He says when there's a tightening announcement that the stock market goes up, it's actually a news effect because it's based on a revised output, but when the stock market goes down after a tightening, it's a pure monetary policy effect because financial markets. So you have these both two effects mixed in your monetary policy shocks, and that's, I think, in the discussion you asked, why don't we see any effects on the other variables? And I think that might be one of the reasons. So I think it would be cool for you to explore these Jarodziński and Karadi. They're publicly available, these effects, and decompose them. And I mean, I do think, going back to my first comment, that the expectation in response to a monetary policy shock in the US will still be dependent on what I expect the local central bank to be. So there's literature out there, for example, for bonds, that say that bonds in emerging markets only move in response to core monetary policy if they expect the local markets to move it. So if you put monetary policy and bond yields in emerging markets, you find a significant effect. But as soon as you control for the local financial market, the effect goes away. So basically the effect is only there if the local market. So that is something you can test. And I think actually your results might be, especially on the other variables, then might be much cleaner. But very cool data especially. and you're able to focus, I think, very squarely on this. And very insightful.
So maybe it's going to be a good question, but are we sure that the firms talk about the same inflation basket as the CPI? Could it be that maybe firms face a different basket, and it may actually be falling because of the recession? Like maybe firms are talking about PPI, but when you are showing CPI, could it
So, yeah, so maybe I can make like a big so first like
There was Xavier.
Ah.
sorry.
So I want to actually bring up a point that Discussant made, the last point about this idea that maybe the U.S. is this discussion that the U.S. is winning the world by raising interest rates, and it's not so clear. I mean, I've done some work. We're doing some work with Uruguayan, and it turns out that it really depends on what the state of the business cycle is for the emerging economies. If you have economies that are already overheated, then when the U.S. raises interest rates, it's going to actually help the rest of the world. So it could go either way. So I think Discussant was saying, one cannot blame
exactly, yeah.
the US.
So first, thanks a lot for your discussion and for your question. Like that are very good, and I think that this debate at the end of basically the effect of the U.S. monetary policy. So there is this paper of Egorov and Mukin, for example, that they discuss more about the effect of coordination and how when you have this kind of effect, like dominant role of the U.S. and the rest of the world, how basically the policy should be, and then of course, if the U.S. is facing, for example, inflation as today, controlling inflation is also give a public good to the world, and then we can debate on how much they should do it and how much they should coordinate with other economies, and that's something I think it's a fascinating discussion, but of course, I don't have an answer for that. So I think I agree with most of you guys. It's true that the selection of the shock it's important, and there is a lot of information. We don't want to enter to this debate. We try with different shocks, we find similar results, but the thing that instead of doing that, we show you transparently what happened in the Uruguayan economy. We saw that basically inflation is something there is some inflation, there is some reduction in economic activity. Something similar happened with other shocks, and we do find that basically for the same time period, for the same shock, Uruguayan firms react in a different level. It's true the standards are low. We can use and that I think is part and artificial of the data, because we have a panel. We have the same shock that is time varying. We can use time clustering standard error by cluster. Standard error is going to be bigger, but the effect basically the magnitude of the effect is going to be quantitatively the same. And at least until that point, I think that it's kind of it's in a way an empirical result that for the same data, firms react differently than what CPI does. It might be that firms have some bias about what the prices are looking at, and this bias happen in terms of the economy. But we thought that for this part of the paper, instead of speculating about what type of bias firm might have, just see this mismatch between the data and the inflation expectation, and try to see what was the case. And then if the central bank made mistakes, or if it is because firms are expecting something about the history, something that basically that is the type of evidence that we wanted to bring into the table with this paper. It doesn't mean that they're stupid or wrongly. It might just be also kind of understanding the policy. It's the same thing that happened with consumers' inflation expectations. So 2 years ago or 3 years ago, we were all saying let's increase inflation expectations so people spend more. Today we discovered that actually when there is more inflation and with higher inflation expectation, people understand something completely different than basically the IS mechanism that we were thinking a year ago. Basically because these questions are complex, and I think that in this case, again, I think the question is more open in the sense, try to understand more how firms create form expectation in the presence of this global cycle. Understanding the policy regime is hard. Understanding what is inflation is hard. All the things that's hard, and then try to mimic that with the policy decision is something that we've tried to bring to the table. We found some very small results in that sense. So I think you're right. In terms of debt, I think it's everything. In terms of debt and import, I think everything points in line to basically expecting a depreciation. So basically, if they expect a depreciation, debt in the foreign currency is going to be more expensive. And that's something that also I'll find, for example, in the case of the Great Depression, that when the US left the gold standard, the depreciation was relatively slow, so firms anticipated by increasing imports. So it might be that this anticipation of more informed firms, for example, is because they're expecting a higher depreciation in the future, so they try to anticipate like increasing their import today, and that maybe that can explain why the effect is so short-lived. But overall, yes, like I think that the evidence point to basically associating a depreciation as something negative for the economy, while because of the nature of the shock is not necessarily the case. But yeah. Thanks a lot for all the discussion. This was super interesting.
Well, I want to say something because I said a few things and then people laughed, and I don't want to leave you with the wrong impression. So I think this stuff is really, really important work, and I commend you for doing it. My reaction, or your paper reminds me a little bit of Nakamura and Steinson, which was published in the AR, so it's a serious piece of work. But there they found that the survey of professional forecasters were, the response of the survey of professional forecasters to their monetary policy shock was moving very differently than actual data was responding. This had to do with GDP growth. Interest rate goes up, professional forecasters forecast GDP is going up, actual GDP went down. And so there's a huge amount of time was invested. And those results, I think we all think now, they were wrong. But I said that to you a moment ago. I didn't mean that you made a mistake or anything like that. But they were wrong because one answer was that the monetary shock was not really, it was a combination of various other things. I think your results are wrong in the sense of Nakamura and Steinson. And so it's not, I do not want to belittle what you're doing. On the contrary, I think this stuff is extremely important, and I commend you for this kind of work. And to be honest, I commend you for standing there and pointing, showing us those graphs. That took a lot of bravery. So I do want to think there's something wrong with those standard errors, I think.
No, we could use time cluster, because it's true that the shock is for the same thing all at the same time. It's gonna increase the size of the standard error, but the result is still gonna be significant. So yeah. Yep.
Any more questions? We have a bit of time. Yes, please.
I just want to find out in terms of the sample selection, right? So we chose 2014 to 2020. Is there or was there any breadth to look at a longer period or shorter period? Because if I think about it, 2014 to 2020 was literally a period of very low US rates, close to the zero bound. Probably till about 2018 when we had the lift off. So you could find that the reactions of the local firms are probably, they could be exaggerated, because there was nothing happening in terms of the US rate in that period, literally, until 2018 or so. So I want to understand whether there was breadth to look at a longer sample period, or rather, on the other side, why did you choose 2014 to 2020?
So it's mainly data availability. So basically, the most when we can merge all these sources of data is for 2014 to 2020. We could have a little bit like back to 2012, let's say, but then like we're still going to be in that period is going to be like a kind of a higher silver bound. The fact that the policy is zero doesn't mean that there are no surprises in terms of monetary policy, but I agree with you that basically it's less interesting in that period of time. But we cannot go further back in that sense. Then we could include COVID, but also we know that the COVID shock is very messy. So, and also like a lot of firms like kind of stop working. So there is a lot of other issues when we do that. So that's why basically we selected that period of time. We would love to have like the 90s or the 80s, but there is no data for that period of time. But you
have 2013, because that was the dip potential. That could be at least, that's the most significant shock for EMs, right?
Yes, so we could. Yeah, so we could have that. So here we sell 2014, but we have like 12 period lag. So we could like it kind of, there is that trade-off between like kind of how many lags we had in our estimation with the effect value.
Great, thank you very much. Thank you.
Well, that is it.
No, pero
Next.
es la base que tenemos.
No, porque más a largo plazo hay inversión.
Yeah, yeah.
Más a largo plazo.
Next, Ekaterina Pireskova from the South African Reserve Bank.
Good morning. Thank you very much for this opportunity to present this workshop. This is a joint work with Giovanni, Nicola. Sorry? Okay. So this is a joint work with Giovanni, Nicola, and Charles. All of them are in this room. This is the work that focuses on the analysis of the effects of monetary policy announcements in South Africa. And the usual disclaimer applies that views expressed here